Friends, I welcome you all to our today's session. Previous session, we are discussing about perquisites, and we have understood for the purpose of perquisites, we have to classify certain employees as specified employees. So let us once again understand who are these specified employees, because there are certain perquisites which are taxable only to this special kind of employees. So let us see them first. Let me share my screen right now. We are going to quickly recapitulate what we have learned in our previous class. After that, we'll proceed. Yeah. In the previous session, when we are talking about perquisites, and we have understood there are certain perquisites which are taxable for all employees, and there are certain perquisites which are tax-free for all employees, and there are some perquisites which are taxable only in the hands of specified employees. That is why we wanted to understand who are the specified employees for whom certain specified some specific perquisites are taxable. And we have also understood in the previous session that what are the items included in perquisites. All these things in detail we have discussed. Right. And this is the meaning of specified employees, which are dealt in section 17(2) clause 3. You can see three kinds of employees are there. One is director employee. That means if a person is a director, even for a single day during the previous year, then he is a specified employee. Okay, and it is applicable only for companies, not for cooperative society kind of thing. So even if somebody may be a director in a cooperative society, he will not be considered as a director. So director employee means we mean complete director. And employees who have substantial interest, those employees who have substantial interest in the company, they will be also called as specified employees. And substantial interest means 20% of voting power. Here 20% is beneficial ownership of shares equivalent to 20%. If it is held individually, then he will be considered as a specified employee. Okay, beneficially held individually means if it is held along with relatives, he will not be considered as a specified employee. The next category is that employee with gross salary, gross taxable salary of rupees 50,000, that is more than 50,000 during the previous year. Okay, if that is so, employees gross taxable employees more than 50,000 during the previous year, he is also a specified employee. Okay, and here this gross taxable salary includes everything, but it excludes non-monetary perquisites and employers' contribution to provident fund. And this gross taxable salary will be considered after allowing deductions under section 16. So section 16, you'll be learning that you might be aware of also three deductions are allowed. One is standard deduction. Second is employment tax or personal tax. Third is deduction for entertainment allowance. So these deductions will be allowed. Okay, and this non-monetary perquisites will be excluded, employees' contribution will be excluded. After that, we'll see whether the gross taxable salary is more than 50,000 during the previous year or not. If it is more than 50,000, then that employee will be regarded as a specified employee. Did you understand? So, I mean director employee who has substantial interest. Third is employees whose gross taxable salary is more than 50,000 rupees during previous year. These three categories of employees are specified employees for our purpose. Okay, director may be a nominee director or he may be a part-time director also. Okay, what I told you right now, you can see the same thing in this slide. Okay, and person with substantial interest, again I repeat, that means 20% or more voting power in the company. We have to consider only beneficial ownership. Yeah. In order to determine whether person has substantial interest in the company, it is the beneficial ownership of the equity shares carrying 20% or more voting power is relevant. Okay, so legal ownership may be different, but on the basis of beneficial ownership, it has to be considered. And it has to be held by the employee himself, not along with relatives. This example also we had discussed in a previous class. Okay, is it clear to you? Now,
Yes, sir.
third category of specified employees whose gross taxable salary is more than 50,000 rupees. Okay. And this is excluding all non-monetary perquisites, employer's contribution, and after allowing deductions of section 2 and 3. Now, friends, in today's session, we will be discussing what are the perquisites which are taxable for all. First, let us see these are the list of perquisites which are taxable only in the hands of specified employees. Okay, so if you can look at here, you can see these are the list of perquisites. First of all, provision of sweeper, gardener, watchman, or personal attendant. If these kind of facilities are provided, it is taxable only for whom? Only for this specified employees, not for a normal employee. Similarly, facilities for use of gas, electricity, water supplied by the employer. If employer is supplying all these things to the employee, it is taxable only in the hands of specified employees. Free or concessional tickets. If these tickets are sponsored, either free, either totally given to the employee, or at some concessional price, then that is perquisites only for specified employees. Use of motor car. If motor car is allowed to be used by the employee, maybe for personal purpose, that is also perquisites, and that is taxable only in the hands of specified employees. Then free or concessional educational facility. This is also taxable perquisites in the hands of specified employees. Okay. Did you understand this?
Yes, sir.
Yes, sir.
These are the list of perquisites. You see, this is taxable only in the hands of specified employees. For normal employees, these are not taxable. Just keep this thing in mind. Then one by one, we'll be covering all kinds of perquisites. Now let us see the perquisites. First perquisites, you see, rent-free accommodation. So you might be aware of sometimes employees are provided with some rent-free accommodation. That means a house is given to them, maybe with furniture, without furniture. First, we are talking about only rent-free accommodation, means without furniture. Okay, without that means we call it as the rent-free unfurnished accommodation. Okay, if that is so, how to arrive at the value of perquisites? Let us. You can have a look at this picture. You can have some idea. So rent-free accommodation, for the purpose of valuation of this, we are classifying employees into three categories. First categories, you see, judges, officials of parliament, union ministers, leaders of opposition, and employee working at specified places. I'm not talking about specified employees. I'm talking about employees working at specified places. Okay, what is the meaning of specified places? So we'll be understanding that. If this is so, then it is fully exempt. Okay. Then this is about some kind of employees. Now come to the extreme right side. You see government employees. In government employees, what happens? Government decides the license fee. Government decides a fee, that if a rent-free accommodation is given, government decides a fee, and that fee amount, that license fee amount, is a taxable perquisite. It is taxable. Okay. Understood? And for other employees, that means not this category of employees and not government employees, maybe private sector employees, then we have to see that whether the house which is provided, it is owned by the employer or it is hired by the employer. Right? If it is owned by the employer, then specified percentage of salary. I'll be telling you shortly what is the specified percentage of salary, depending upon the population of the place of accommodation. And if it is hired by the employer, that means employee is not the owner of that house. It's not his own house. But employee has taken that house on rent and given it to the employee as a rent-free accommodation. In that case, rent paid or payable by employer or 15% of salary. Whichever is lower will be taxable. Did you understand it broadly?
Yes, sir.
Okay. Now let us try to elaborate this chart. Now, what I told you, these kind of employees like judges of High Court, Supreme Court, officials of Parliament, union minister, leaders of opposition. For them, if rent-free house is provided, what will the treatment?
Fully exempted.
Fully. And government employees, and here government employee does not include employees of local authority or foreign government. Government employee here means central government and state government employees. And what is taxable here? The license fee of such house shall be taxable. License fee shall be determined by the central government in accordance with the rules framed by the government. The government will decide the license fee, and that license fee will be included in the salary as a taxable purchase. Okay. Now, you know, in some specified sites also. So if you recall the chart, you see some specified places. If the house is provided to employees working in the specified places, then also it is exempt. And what are the specified places? You see, if the employee is working in a mining site, onshore exploration site, project execution site, dam site, power generation site, or in a temporary offshore site having plinth area of less than or equal to 800 square feet, located 8 kilometers or more from municipality or cantonment board or NAC, or a remote area, if employee is located in a remote area which is 45 kilometers away from a town having population of not more than 20,000. If this is the kind of situation, and in these places, let us say one accommodation is provided, what is the treatment of that accommodation?
Fully exempted.
Here also you can see it is fully exempt. Okay. And you see other employees, I told you, other employees, if house is owned by the employer, so there will be a specified percentage of salary depending upon the population of the rent-free population of the place of rent-free accommodation. Let us see how to deal with that. You have to see where the rent-free accommodation is provided. If it is provided in a city, as per where the population is not exceeding 10 lakh, sorry, the population is not exceeding 10 lakh, as per the 2001 census, then how much will be value? What will the value of the perquisite? It is 7.5% of the salary. Right. And if it is exceeding 10 lakh, but not exceeding 25 lakh, it is 10% of salary. If it is exceeding 25 lakh, it is 15% of the salary. Okay. So all these things will, this is how perquisites will be valued if the house is owned by the employer. But let us say house is not owned by the employer, but it is hired by the employer. Employer himself has taken the house on rent. Then what will be the value of perquisite? This will be rent paid or payable by the employer, or 15% of the salary, whichever is lower. So you have to compare these two things. Whichever is lower, that will be taxable. Is it clear to you?
Yes, sir.
Yes,
So
sir.
if house is owned by the employer, then it may be 7.5% or 10% or 15%. It depends upon the population in the place where accommodation is provided. But if house is not owned, then we have to see how much rent is paid and 15% of the salary. You have to compare these two, and the lower amount will be the value of perquisites. Okay, once again, you can refer to the chart. You'll be having some clear understanding. Okay, have a look. You can see for some people like judges, officials of parliament, opposition leader, union minister, and employees working specified in places, it is fully exempt. Government employee license fee is taxable. Other employees, if house is owned, then a specified percentage. If house is hired, then rent paid or payable or 15% of the salary, whichever is lower. Did you understand this concept now? Rent-free accommodation.
Yes, sir.
Okay. Okay. I told you now this is salary. We need 57.5% of salary, 10% of salary, 15% of salary. How to compute? What is the meaning of salary for the purpose of rent-free accommodation? Please try to appreciate the meaning of salary for rent-free accommodation is different. It means basic salary plus DA if it forms a part of retirement benefit. If DA does not form a part of retirement benefit, then DA will not be included. Next, all commissions, whether it is fixed as a percentage of turnover or not, doesn't matter. All commissions will be contractual bonus. If as per contract of employment and bonuses to pay, that will also form a part of rent-free part of salary for the purpose of rent-free. All taxable allowances, then other monetary payments by whatever name called. Okay, monetary payments means perquisites will be excluded. Perquisites and non-monetary. Excluding employers' contribution to provident fund. Employers' contribution will be excluded, but all other monetary payments will be included. This is the meaning of salary for the purpose of rent-free accommodation. Is it clear to you?
Yes, sir.
Good. Now, so if I again summarize, you see salary includes basic pay, DA forming a part of retirement benefit, bonus, commission, fees, but it doesn't include DA if it is not taken for retirement benefit. It doesn't include the employer's contribution to provident fund, exempted allowances, and perquisite value under section 17. Okay. And you can see lump sum payments at the time of retirement, that will also not be included. Taxable allowances will be included. Perquisites will be excluded. Okay, perquisites are non-monetary in nature. Right? You can have a look at this. And in this context, you have to remember that fair rent of the house, municipal value of the house is irrelevant. Friends, will be when you will be computing income under the head house property, will be understand at that time we may use this data. That is, what is the fair rent, what is the municipal value, those things will be relevant to compute income under the head house property. But when the same house property is provided as rent-free accommodation, the fair value or municipal value is irrelevant. Okay, suppose municipal value of the house might be, let us say 20 lakh, but it is given to a government employee and government license fee is only 200 rupees. Then 200 rupees will be considered as a value of rent-free accommodation, because for government employees it is a license fee. So the fair and municipal value will be irrelevant. Okay, and for other employees, you know how it is to be computed. It depends upon whether house is owned by the employee. It depends upon the population. Or when house is at rent, it also depends upon the salary and rent payable. Okay. A movable house is also treated as an accommodation and shall be taxed. Suppose rent-free accommodation is given as a tent or in a mobile home, or let us say a boat house. All of them are houses. Movable houses are also houses. One cannot claim that it is not a house, it's not a rent-free accommodation. No. Law has made it clear that movable houses are also houses. And you know, to arrive at the value of the perquisites, we need to compute what is the salary. And salary has to be computed only for the period during which house is occupied by the employee. Suppose house is occupied by employee for 6 months. Then only for those 6 months, what will be the salary? That will be taken into consideration. Now, accommodation is provided by central or state government to deputed employees. Where accommodation is provided to government to a non-government employee who is serving on deputation with any body or undertaking under the control of such government, the value of such perquisites shall be computed as in case of non-government employees. Sometimes what happens? Government employees go on deputation to some non-government sector. Let's say there is a government employee, he has gone on deputation to be a director of a corporation, government corporation, which is under control of the government. And in that corporation, he is given rent-free accommodation. In that case, that rent-free accommodation will be valued, and for that purpose, the government employee will be treated as a non-government employee during the period of his deputation. Is it clear to you?
Yes, sir.
Okay. Now, if you read it clearly, it says accommodation provided by government to non-government employees. So what I told you, I think we have to reinterpret this thing. Okay, so accommodation provided by the government to non-government employees. Actually, this is the accommodation is provided to a non-government who is serving on a deputation with any body or an undertaking under the control of such government. That means actually here situation is reversed. What has happened here? A non-government employee is provided accommodation, and this non-government employee is under deputation within a body which is under the control of government. In that case, that non-government employee will be treated as non-government employee. Is it clear to you? I think
Yes,
there was some confusion, but now I think if you read it clearly, you can understand. Okay, we are talking about accommodation provided by the government to a non-government employee. Basically, that person may be, that employee might be a non-government employee, but who is on deputation. Deputation to a government undertaking. Then he will be treated as non-government. Okay, and one more issue, one more typical issue is that an employee might be working with more than one employer. If that is so, if employee is working is more than one employer, then all the salary has to be aggregated for the purpose of valuation of purpose. Okay.
yes, sir.
Clear? Okay. Now, sometimes accommodations are provided after retirement. In that case, employee might be receiving pension. The uncommuted pension from another employer shall form a part of salary for rent-free accommodation. As all perquisite monetary payments shall also be included in salary. Here point is that if the employee is receiving some uncommuted pension means periodically he receives some pension from another employee. So that will also be included in salary.
Yes, sir.
And gratuity received during continuation of the service shall be considered for computing salary of rent-free accommodation purpose, as all monetary payments which are not in the nature of perquisites shall also be taken into account. Since all non-monetary payments has to be taken into account, so if gratuity is received during continuation of service, not at the time of retirement, that will also be included in salary. However, long-term gratuity received at the time of retirement shall be included. Okay, gratuity received at the time of retirement in lump sum, that will be included. But during continuation of service, if gratuity is received, that will be forming a part of salary. Leave encashment received during continuation of the service shall be considered for computing salary for rent-free accommodation. Okay. But however, lump sum leave encashment received at the time of retirement shall be. So during continuation of services, if the employee has received some leave encashment benefit, that will be taken. But however, advance salary or arrears of salary if employee has received, because of which he is receiving more salary, this advance salary and arrears salary will not be.
Yes, sir.
Okay. One thing I make it clear also, that this rent-free accommodation is taxable for all employees, whether he is specified or non-specified. Specified employee, you know, three category employee: director employee, employee with substantial benefit, and employee with gross taxable salaries more than 50,000, subject to some condition. So irrespective of that, whether employee is a specified employees or a non-specified employee, this rent-free accommodation is taxable for all. Is it clear to you?
Yes, sir.
Now, one more complex situation. If there is more than one rent-free accommodation, then all such houses are taxable. But however, there is more than one rent-free accommodation, and this is in connection with a transfer. Let us say employees transferred from one place to another place. And during that time, he is having two rent-free accommodations. In that case, what will happen? The value of perquisites shall be for the accommodation which is lower value. Both the accommodation will evaluate whichever is the lower, that will be taken as the value of perquisites only for 90 days. Okay. Beyond 90 days, both the houses will be taxable. So one house will be taxable, even if the employees is provided with two houses. One house which is of lower value will be taxable only for 90 days. Beyond that, both the houses will be taxable.
Yes, sir.
Is it clear to you? Okay. So within
Yes,
90 days, ideally, employee needs to surrender the house in case of transfer. Otherwise, both the houses will be taxable. Now, this is the treatment about value of this thing on furnished accommodation. Now, let us see how to do valuation for furnished accommodation. Here you have to do, first we'll assume that it is an unfurnished accommodation. So accordingly, we'll do the valuation of properties. So first consider as if the rent-free unfurnished accommodation is provided. Then we'll be adding the value of furniture. But here we have to see two things. One is that whether furniture is owned by them. Second, whether furniture is hired by them. If furniture is owned by the employer, then just add 10% of the original cost of the furniture. Okay, so every year 10% will be added to the value of, added to the 10% of the cost of the furniture will be added to the value of unfurnished accommodation. Did you understand this?
Yes, sir.
Okay, suppose rent-free accommodation is valued as 2 lakh, but furniture is provided worth 1 lakh. Original cost is 1 lakh. So 10% means with their 2 lakh, then 10,000 will be added every year. Okay. And let us say house is provided for, will be provided for 15 years. So every year 10%, 10%, 10%. So after 10 years, what will happen? The original cost of the furniture will be exhausted.
Yes, sir.
But still, this 10% will be added.
Yes.
Okay.
Yes,
So
sir.
even if, let us say, employer is provided a fridge in the furnished accommodation, and fridge value, let us say 20,000. So every year 2,000 rupees will be added to the value of accommodation. But after 10 years, you see entire 20,000 rupees has been added, but this 2,000 rupees will be continued to be added so long as the furniture is provided.
So I have a doubt.
Yes, please.
So Sir, suppose the government employee has his furniture of his own and he doesn't want to use the furniture that is given by that is accommodated to him or given by the government to him. So can he surrender that and use his own, and therefore that 10% of original cost to him?
Yeah, it depends upon his terms of employment. If he is not using, he will be able to surrender.
Okay, sir.
Normally, in terms of employment, have that kind of provision. If you are not using, you can provide, you can surrender.
Yes, sir.
Okay. Now, first case I told you, when furnitures are owned by the employer, that is, employer has purchased the furniture. Second case, employer has not purchased furniture. What employer has done, employer has hired the furniture and provided it to the employees in the furnished house. In that case, the actual hire charges will be added. Okay. Let us say fridge is hired by the employer, and employer is paying 2,500 per year. Then 2,500 rupees will be added. Okay. And
Yes,
friends, remember, for income tax purpose, furniture includes household appliances like TV, refrigerator, AC. All these things will be considered as furniture. And this treatment, that's 10% of original cost or actual hire charges. This treatment will be same for government employees as well as non-government employees. Okay. For unfurnished house, valuation will be different for government employees and non-government employees. For government employees, license fee. For non-government employees, there are different formulae to calculate that. And market value of the furniture or written down value of the furniture, that is after depreciation, what is the value of the furniture, that has got no relevance. Only original cost is relevant or actual hire charges are relevant. So even after 10 years, when the original cost is fully recovered or fully valued, fully taxed, still it will be taxable, so long as the employee is using that furniture. And this furnished accommodation is taxable both for specified as well as unspecified employees.
Yes, sir.
Is it clear to you?
Yes, sir.
Okay. So friends, we have seen how to arrive at the value of perquisites of a unfurnished accommodation for different kind of employees. We have also said if furniture is provided, how that will be added, how the value of furniture will be added to arrive at the value of furnished accommodation. Now, one more issue we need to see, that is, here accommodation is not provided free of cost, but it is provided at a concessional. So this is also possible. Sometimes accommodations are provided at a concessional. That means, think of an example. Suppose market rent is market value of this thing 10,000 rupees, but the employer is charging 1,000. Here, how to do the values? So valuation of accommodation provided at a concession rate shall be made like this. First of all, we have to see as if employee has been provided rent-free accommodation. So rent-free accommodation, you know how to arrive at the value. Just now we have covered.
Yes, sir.
Then the amount so computed will be reduced by the rent payable by the employee. Suppose we arrive the value of this accommodation is, let us say, 1 lakh rupees. But employer is collecting 20,000 rupees from the employee. Then the 20,000 rupees will be reduced. So the value of this rent-free accommodation will be 1 lakh minus 20,000 rupees. It will be 80,000 rupees. Did you understand?
Yes, sir.
Okay. So, friends, this was about the perquisite rent-free unfurnished accommodation as well as rent-free furnished accommodation. And you have to see there are some complexities, so many issues are there as regards to this valuation of accommodation. Okay. Now, next, let us move to the next part. This is free accommodation in hotels, motels, guest houses, service apartments. If any accommodation is provided in these places, in a hotel, motel, guest house, or service apartment, what will be the value? Let us learn that. So this is a taxable for both for government employee as well as non-government employees. The value will be 24% of the salary for the period for which accommodation is provided for. Let us say accommodation is provided for 1 month, you take that 1 month salary. And 1 month salary, compute 24% of that. That is one calculation. And one more thing, you have to find out what is the actual charge and paid. Actual charges paid or paid. So actual charges are 24% of the salary. Whichever is minimum, whichever is lower, that will be the value. Okay. If rent-free accommodation is provided in hotel, motel, guest houses, or service apartment. Understood?
Yes, sir.
But this type of perquisites will be exempted if this accommodation which is provided is not exceeding 15 days. So if it is a very short-term accommodation, for few days it has been provided, 2 days means not exceeding 15 days. That means up to 15 days one may stay in these facilities without being taxed. But if it is more than 15 days, then we need to value the perquisites. Okay. And this 15 days is only for the purpose of shifting. Let us say an employee shifted from one place to another place. And in the new place is provided a hotel for 15 days. For 15 days, it is not a taxable perquisite. But if it crosses 15 days, then the extra period beyond this 15 days shall be taxable. Let us say employee has stayed for 20 days. Then after 15 days, it is exempt. But for the remaining 5 days, it will be taxable. Not the entire 20 days. Please appreciate that taxable will be only for the remaining 5 days, for those extra days. Did you understand?
Yes, sir.
Okay. Now, let us see the next perquisite. That is, next perquisite, as you can see, it is about insurance premium paid by employer. Friends, try to appreciate that payment of insurance premium is the responsibility of the employee. It is the employee's life, employee has taken insurance. But however, as per terms of employment or maybe voluntarily, employer may decide to pay the premium. If employer is paying, it is a benefit to the employer. And that benefit will be treated as a perquisite. And it is fully taxable both for specified as well as unspecified employees. It is a perquisite. Okay, it will be included in salary. But many of you might be aware of that insurance premium, when is paid, employee is or any person, any individual is eligible for a deduction under section 80C. That means from the gross total income, when we are discussing the concept of total income at that time, we have discussed the total income is the gross total income minus chapter 6 and deduction. So insurance premium can be claimed as a deduction. That's a different story. But first of all, it has to be included as a taxable perquisite. Then the amount of premium paid, that will be deducted. Is it clear to you? For example, let us say your life insurance premium is paid by your employer. Your company is paying your life insurance premium. It will be included in your salary. It is a taxable perquisite. You are getting a benefit because your life insurance premium you should have paid. Okay, it will be included. So salary will be more. So consequently, gross total income will be more. But the same amount which is included will be allowed as deduction, subject to the limits which is provided under section 80C. Okay, so employee can get the benefit of this insurance. Okay, friends.
Yes, sir.
And what I told you right now, this is about life insurance. But in case it is medical insurance, not a life insurance, now treatment will be different. Are you getting me? In case it
Yes,
is
sir.
a medical insurance, that means employer is paying, but it's not life insurance payment. It is a medical insurance payment. Then, as you can see, it is not taxable. It's not taxable for employer. Okay. And it is also not deductible under section 80DD. Suppose medical insurance you will be paying for yourself. Then it is deductible under section 80DD. 80DD, the deduction is allowed. But here you are not paying. Who is paying? Employer is paying. Since employer is paying, that will be treated as his business expenditure. But for employee, it will not be allowed. So it's not taxable, it's not deductible. But life insurance is taxable, but deductible.
Sir, I have a doubt.
Understand the difference? Yeah, please now.
So, under the ESI, that employees are provided certain medical facilities.
Okay.
So, by virtue of the ESI contribution, so whether the ESI contribution that is being made by the employer on behalf of employee, whether that is taxable or not.
No, what is your question? Whether the medical facility is taxable or not?
Sir, under ESI, employees are entitled to get some medical
Okay.
benefits.
So here the question is not about medical premium. You're talking about medical facility. Okay. So friends, try to appreciate. I'll be telling you in appropriate time. Right now, I want to enter into that area very shortly. Maybe in today's class, we'll be covering that thing. Try to understand medical facility is different thing. Medical allowances are different thing. Medical reimbursements are different thing. And this medical insurance premiums are different. Now, your point is that whether that medical facilities, in certain places when this medical facilities is provided, it is tax-free, but in some situation it might be taxable. So when I'll be covering that medical facility, I think it would be better to address that thing. And medical allowances also, we have already covered medical allowances. Is it done? Yes. Allowances are covered. You know, medical allowances are fully taxed. I repeat, medical allowances are fully taxable. Right. And medical facilities will be learning some. At that time, your issue will be covered.
Yes, sir.
Okay. Now, medical insurance, what you understood now? Medical insurance, if it is paid by employer, it is not taxable. Okay. It is not taxable, it is not. But life insurance premium paid by the employer is taxable. It is by perquisite, it is added to the salary, and it is also deductible. Right, friends?
Yes, sir.
Okay. Now, medical facilities, we are coming there shortly. I'll be telling you. Okay, friends. Now, next is this thing about gas, electricity, water facilities. Yes, friends. This perquisite is about facilities provided by way of gas, electricity, water facility. So these are something sometimes employer provides gas connection free of cost, or electricity connection, or employer provide what facility to the employees. So these are basically non-monetary benefits. Consequently, these are perquisites. This needs to be valued, and these are taxable. First, we have to see that what is the source of this provision, whether this facility is provided from its own sources or the facilities are hired or purchased by the employer. Suppose you see, employer is himself is the manufacturer or producer of gas, and he is providing that gas facility to the employees. That means here employee is providing from its own sources. If that is so, then the value of perquisite will be manufacturing cost. Are you getting? Or let us say employer is generating electricity. It's an electricity generation company. Then the value of this perquisites, this taxable perquisites, will be manufacturing cost. Got it?
Yes, sir.
But if that facility is hired or purchased, then the purchase price or the actual higher prices paid, that will be treated as the value of the perquisites. Okay.
Yes, sir.
Okay. Right. Now, few additional points you have to understand. If these facilities are in the name of employee, that means gas connection is in the name of the employee, then it is taxable for all employees. But if it is in the name of the employer, that means gas connection is in the name of the employer, electric connection is in the name of the employer, but employee is used. If that is so, it is taxable only for specified employees. You know who are specified employees? I think you'll be able to recall. Director employee,
Yes, sir.
employee with
Director
substantial
employee.
interest, and gross taxable salary exceeding rupees 50,000 per annum. They are
Yes, sir.
specified employees. Okay. So this gas, electricity, water facility is taxable for all if it is given in the name of the employee or the facility is in the name of the employee. But if it is in the name of the employer, then it is taxable only for specified employees. Is this point clear to you?
Yes, sir.
Okay. Now, again, what I told you, you can have a look at this table. It will be more clear to you. So same, the provision of gas, electricity, and water facility, it may be given at free of cost or may be given at a concessional rate. So the value will be like this. Find the cost to the employer, because if it is supplied from one sources, then the manufacturing cost per unit on that basis will be computing the value of this percentage. If it is purchased or hired, then actual paid or payable, we need to find out that figure. Okay. And if some money is recovered, let us say it is not given entirely free, but some money is recovered. Let us say actual electricity cost is 10,000, but employer is recovering 500. Then 10,000 minus 500. 9,500 will be taxed. Is it done?
Yes, sir.
Okay. So if some recoveries is there, that will be reduced from the taxable purpose. Okay. I think the table is clear to you. Find out the cost to employer. It might be manufacturing cost. It might be amount paid minus amount recovered. The balance amount is the taxable purpose. Okay. Now let us move to the next one today. This is about domestic servants. Sometimes these facilities are also provided by employer to employees. Free domestic servant, or maybe some money may be recovered on account of domestic servant facilities. How to arrive at the value of that purchase? First, we have to see these are various combinations are there. First of all, we'll see who is appointing the servant. Servant may be appointed by the employee or employer. Is it not? Then who is paying the servant salary? On that basis, we'll decide what is the value of the. First, try to appreciate the servant may be appointed by employer or employee, but if the servant's salary is paid by the employee, who is paying this servant salary? Are you getting
Employer. Yes.
employee? Employee is paying. Even if employer is appointed, employer has appointed him. even if the employer has appointed, or maybe employee himself has appointed, it doesn't matter. Employee appointed by employer or appointed by employee, but payments are made by employee. In that case, do you think it is a perquisite? Because salary is paid by the employee, so it is not a perquisite at all.
Yes, sir.
So value of perquisite will be nil, so it is not taxable. Okay, even if employer has appointed, but so what? Salaries are paid by employee. So it's not a perquisite. But let us say situation is different. Appointed by employer, but payment by employer. The salary is also paid by employer. Employer's servant, employer is paying the salary, but facilities enjoyed by employer. In that case, the actual cost incurred by the employer on this servant shall be the taxable perquisite. Actual cost, whatever salary is paid. And again, it is taxable only for whom? You can understand it is taxable in the hands of
Specified employees.
only for specified employees. In which situation? Appointed by employer and salary is paid by employer. But on the other hand, if appointed by employee, employee is one servant, but salary is paid by employer. Here also actual cost incurred by the employer will be taxable. Okay, but here it is for whom? It is for all employees. Okay, it is for all employees. So appointed by employer, salary paid by employer, only for taxable employees it will be taxable. But appointed by employee and servants, salaries paid by employer, it is taxable for all employees. Okay, it will be perquisites only when salary is paid by the employer. If the salary is paid by employee, it's not a perquisite at all. Right? Understood? Here we are talking about the facilities of domestic servant. But if it is not a facility, it is an allowance or it is a reimbursement, then it is taxable for all employees. Okay. So reimbursement and allowances are taxable for all.
Yes.
Only when it is a facility, then it may be taxable to specified employees or all employees, depends that who has appointed the servant. And friends, you see, servant you see includes here cook, gatekeeper, maid. Right? Gardener is not included here, you see. Driver is not included. Those things will be separately will be taken. Are you getting me?
Yes, sir.
Gardener, drivers are not included. Watch it carefully. Cook, gatekeeper, maid, they are included. And if it is not a fully, let's say, free facility, if it is a concessional facility, that means some money is recovered from the employee, then the amount charged from the employee shall be reduced from the value of the project. So first you evaluate what is the value of per project. Then therefrom reduce the amount of charges which are recovered by the employer. Are you getting it? Yes or no? Did you
Yes,
understand?
sir. Yes, sir. Yes, sir.
Okay, friends. Now, next you see, next perquisite is gardener facility. Okay, gardener is different from domestic servant. You see, it is fully taxable to the extent cost incurred by the employer. To the extent cost incurred by the employer means the employer might be paying the salary. To that extent, it is fully taxable. But in some situation, it is exempt. Gardener facility and garden maintenance cost is exempt if rent-free accommodation is provided and the accommodation is owned by the employer and gardener is appointed by employer. That means employer's house, employer's garden, employer's gardener. If all these things are there and employer is owned that house, then it is exempt. Okay. That means employer for his own house has kept a gardener and provided it as a rent-free accommodation to the employee. If that is the situation, then gardener facility is exempt. Otherwise, it is fully taxable to the extent cost incurred by the employer. Is it clear to you?
Yes, sir.
Okay, friends. Now, next point is education facility. Now, look at the chart. Look at this chart, education facilities. We will classify them into three broad categories: provided to employees, then provided to the children of employees, then provided to other relative of employees. First, remember, if this education facility is provided to the employee himself, then it is not taxable at all. And if you come to this side, you can see if it is provided to the other relative of the employee, that is not to the children. Let us say it is provided to the employee's spouse or employee's brother, kind of situation. Then it is fully taxable. Is it clear up to this? So education
Yes, sir.
facilities to employee is fully exempt. To other relative of the employee except children, it is fully taxable. Now comes to education facility, which is provided to the children of the employee. Now here you have to see that where this facility is provided to the employee children. It may be provided in an institution which is owned or maintained by the employer. That means, let us say, school facility is provided and school is owned by the employer. Or it may be provided by virtue of employment in other institution. He is employed in some institution, and by virtue of that, because of his employment, this education facility is provided maybe in the same institution. If that is so, then the cost of education in similar institution in the locality will be taxable. That means will arrive at if these children will be educated in a similar education, a similar institution in the same locality. What will be the value? And that value is the value of birth. Okay.
Yes, sir.
But if it is provided otherwise, that means it is not provided in that institution, it is provided otherwise. Some other facilities provided. Some what is otherwise, we have to think. Maybe it is provided by way of reimbursement or something like that. Then the cost of education, whatever is the cost employer is incurring, that is taxable. Cost of education will be taxable. Okay.
Yes, sir.
Right. Fine. Understood this?
Yes, sir.
So if you want to see, you can see the exact rule 35 of Income Tax Rule 1962. Okay, it talks about the value of benefit of the employee resulting from provision of free or concessional education facility to any member of his household shall be determined as the sum equal to the amount of expenditure incurred by the employer on that behalf. Or where educational institution or itself is maintained or owned by the employer, or where free education facilities to such member of the employee's household are allowed in any educational institution by reason of his being employment as an employer. The value of perquisites of employees shall be determined with reference to the cost of such education in a similar institution or near the locality. So that is the value of perquisite in this kind of situation which I discussed. And here one more provision: if any amount is recovered from the employee, that means it is a concessional facility, then the value of perquisite shall be reduced to that extent. So that is true in every case. Wherever some money is recovered, value of perquisite should be reduced by that. Okay. So what we discussed till now, it is about education facility. But now we are talking about free education, some related points. Value of this perquisite shall be nil if the cost of education or the value of benefit for child does not exceed 1,000 rupees per month. Okay, the perquisite value is nil if the cost of education doesn't exceed 1,000 rupees per month. Where cost of education exceeds 1,000 rupees per month, the whole amount shall be taxable in the hands of employee. Not that the excess amount over 1,000 will be taxable. No, the entire amount will be taxable. So up to 1,000 it is exempt, but except exceeding 1,000, the entire amount will be taxable. Reimbursement of education expenditure to employee is fully taxable. Reimbursement of school fee of family members of employee directly to school, taxable for all employees. Concessional facility, that is, if amount is charged from the employee, it shall be reduced from taxable value of purchase. And here we are talking about employee children, and here employee children include stepchild, adopted child, but does not include a grandchild or illegitimate child. Scholarship on the basis of performances are not taxable. Performance-based scholarship are not taxable. Employer has given some scholarship to the employee children on the basis of performances. That will not be taxable. Contribution to educational trust, where the beneficiary is the children of employee, it's not taxable. That means here what is happening, employer might have created a trust where beneficiaries are the employee children and employer is contributing to that trust. That contribution is not a taxable profit. Did you understand all these points?
Yes, sir.
Okay. Now, friends. Okay. Next, you see one more perquisite. Value of interest-free loan. Let us say interest-free loan is provided by employer. Employer has given some loan to the employees without charging any interest, or maybe concessional interest. We'll see it later. So what we'll do, we'll find out interest as per State Bank of India lending rates and the interest paid by employees. So for State Bank of India lending rate is 8%, of interest paid by employees is 2%. The difference of 6% will be taxable. Is it clear to you? Yes or no? SBI lending rate and interest paid by employee. The difference will be the taxable perquisite. However,
Yes, sir.
no tax, that means it will not be taxable if the loan in aggregate does not exceed 20,000. Let's say a small loan is taken only for 20,000 rupees or for 15,000 rupees, 20,000 or less. Then even if it is given free of interest or at a concessional rate, that is not taxable. Or if the loan is provided for treatment of some specified diseases, employer has given a loan to the employee for his treatment for some specified diseases. What are the specified diseases? They are mentioned in Rule 3A of Income Tax Rule 1962. We'll be seeing that. Okay, so in these two cases, that means aggregate of loan not exceeding 20,000 rupees, and the treatment is loan is for treatment of specified diseases. Then it is not taxable, otherwise it is taxable. And if any amount is charged by employee, let us say it is a concessional loan, it is charged to the employee, then the whatever amount which is charged, this will be reduced from the value of the property. Okay.
Yes, sir.
Right. Understood this?
Yes, sir.
Now here, let us try a question for you. Let me show you a question for you. Try to solve it. You have understood the provisions. You can have a look at this provision once again, and we'll be quickly solving this question. Now you see, as you can see the table, this is the example given to you. Try to solve it. So you see, number of loan means how many loans the employee has taken. One loan, two loan, two loan. Loan amount you can see 15,000, 25,000, then 10,000 and 8,000, then 10,000, 11,000. Interest charge is this one. SBI lending rate is 10%. Find out the value of purchase and what is the taxable amount. Taxable amount of interest thereof. Will you try the first one?
So first one will be taxable because it does not exceed 20,000.
Very good. First one is in SBI lending rate, you can see 10% is 1,500. Value of perquisite is 1,200, but taxable amount will be nil because the amount doesn't exceed 20,000. Okay, SBI lending rate is 1,500, but employer is charging 300. So value of perquisite is how much? 1,200. But 1,200 will not be taxable. Okay, second case, can you tell me? What is the value of perquisite and how much will be taxed?
2,000.
Let us see. So SBI lending rate, if you calculate it 2,500 interest at the SBI lending rate, then value of perquisite is 2,000 rupees, 2,500 minus 500 which is collected. So taxable amount will be 2,000 because the loan amount is exceeding 25,000. Case 3. Here there are two loans.
So it won't be taxable first of all because the aggregate does not exceed 20,000.
Very good. So even if you know the value of the perquisite is 800 and 640 respectively, taxable amount will be nil because the total is less than 20,000. Fourth case.
Sir, 1,680, I guess the value of it.
Yeah, 1,680. So you can see it here. Individually, even if they are not exceeding 20,000 rupees, but aggregate value is exceeding 20,000. So accordingly, so interest at SBI lending rate is 1,000 and 1,100 respectively, and interest charge is only 200 and 220. So the differential amount 800 and 880 are value of perquisites, and this 800 and 880 are taxable. I think you have understood this concept.
Yes, yes.
Okay. Right, friends? Now, let us move to the next perquisites. So this is, you see, perquisites given in the form of movable assets. If some other movable assets are given like laptop, computer, mobile, etc., how to arrive at the value of that perquisite? This chart is going to explain you. So you can say laptop, computer, mobile. If these three things are given by employer to employee, what will be the treatment?
Sir, fully exempt.
It's fully exempt. So it is not a taxable property. Okay. And if some asset is given for official use, asset is given for only for official use, something is given. Okay, some equipment is given to you. Let us say a projector is given to you, and it is for official use. You cannot make personal use. Since it is official use, practically it is not a perquisite. So it is again fully exempt. But if some assets are given for personal use, then we have to see it whether it is owned by the employer or hired by the employer. If it is owned, then just like furniture, what we are doing, 10% of the original cost of value of purchase. If it is hired, then charges payable by the employer will be taxable.
Yes, sir. So 10% of the original cost means like after 10 years, the original cost will be recovered. So it will continue to be around like
It will
the
continue
previous.
to be charged. If the asset is provided, still provided, it will be this. This will be the value of the perquisites will be again 10%. Okay, so treatment you see it is more or less just like your furniture. Okay, and if some money is recovered, let's say it's a concessional facility, then the money recovered will be reduced. So use of laptops, computers, and mobile phones, value of benefit is nil. Movable asset other than those three things, then 10% of the actual cost of such asset. If the amount is rent paid, then that amount less the amount recovered from it. I think it is clear to you.
Yes, sir.
Yes, sir.
Now, this is one more perquisite. This is what movable assets sold, they are sold to employee. When assets are sold to employee at a concessional price, it is a perquisite. And now this is an important thing. Watch it carefully. And we are referring to this particular rule, rule 37778. If you refer here, let us say computer, laptop, printers are which are used by that means the employer's computer, laptop, printers are sold to employee. That what is the perquisite here? We have to see, you have to apply depreciation at the rate of 50% per annum. We'll see what is the reduced value. So depreciated value in excess of the sale value shall be taxable. Let us say depreciated value of the computer has come to 2,000. Okay, and employees are sold, or let us say these products are these computers are sold to employee for 1,000. But I told you depreciated value 2,000, it is sold to employer 1,000. So employee is gaining 1,000 rupees, is it not? So that amount is taxable. So this is taxable only when the depreciated value is in excess of sale value. Are you getting me, friends?
Yes, sir.
Okay, so for computer, laptop, printer, depreciation rate is 50%. But for car, let's say car is sold to the employee. Here depreciation rate is 20%. So every year 20% rate it will be depreciated. After that, we will see what is the written down value or WDV. Okay, every year 20%. So written down value we'll be seeing, we'll be calculating. You know written down value depreciation. So let us say first year car value is 10 lakh, so 20% will be reduced. So next year it will be 80 lakh, 8 lakh. On 8 lakh, 20% will be applied. Okay, so 1,60,000 will be the depreciation. So like this is called as a written down. So for car, 20% depreciation will be charged on written down value. And we have to see if the sale value is less than the written down value, then the employee is getting a benefit that will be the taxable for. Let us say written down value is 5 lakh, but sale value is 4 lakh. The excess 1 lakh rupees will be taxable for. Is it okay?
Yes, sir.
And for any other asset except computer, laptop, printer, and car, maybe any household appliances, the rate of depreciation is 10%. And here it is not written down value, it is straight line method. That means every year same depreciation will be charged like a straight line. Suppose value of the asset is 1 lakh, every year 10,000 rupees, 10,000 rupees, 10,000 rupees will be charged straight way. But for computer, laptop, printer, and car, it is written down value method. Understood? Yes or no?
Yes, sir.
And here you see depreciation shall be charged for each completed year.
Yes, sir.
Okay, for each completed year and no depreciation for part of the year. Okay, let us say car is just used for 1 day and it is sold to the employee. No depreciation will be charged because it's a part of the year. Depreciation will be charged only when it is for the complete year. Okay, so this is one more provision you have to remember. Okay.
Yes, sir.
What I showed you in the chart, you can see this slide. Computers and electronics items, then 50% depreciation. Okay, at WDV, motor cars 20% depreciation at under written down value, other assets 10% depreciation and straight line method. Now, this is what you are asking, in fact, from the very beginning, that is medical facilities. Okay. Right, friends?
Yes.
Yes, friends. From the beginning, you are asking that how to deal with medical facility. This is not about medical allowances, which are fully taxable. You are well aware of. Now we are learning about medical facilities. Now you see, we can classify this thing. Medical facilities provided in India or outside India. Okay, first let us see how will be treatment if it is provided in India. And your question was, it is about something medical facilities provided in an ESI hospital, right? This was your question.
Yes, sir.
Okay, so first let us understand the provision, then we will try to address your issue. We will see where exactly your situation fits. Basic provision you have to understand that this medical facility can be provided in India or outside India. If it is India, it can be provided at the workplace itself. Workplace means maybe in the office itself there is a dispensary, or maybe in the factory premises there is a hospital. That kind of situation, you can say that is in the workplace. Or it may be a government declared hospital. Mind you, I'm not saying government hospital. It might be a government declared hospital, or it may be some other places. Right. And if you see, look at this chart, you can understand medical facilities provided at the workplace. What is the treatment? At the workplace, medical facilities provided. What is the treatment for tax?
Not taxable.
It's not taxable at all. If it is provided in a government declared hospital, what is the treatment?
Not taxable.
Again, not taxable. Now question comes, it is if it is from some other places. If it is some other places, then we have to see if it is for specified diseases or other diseases. If it is some specified diseases, then what is the treatment?
Not taxable.
Not taxable. The specified diseases concept we are also discussing previously, where loan given to the employee for some specified diseases. At that time also I told you, I'll be telling you what are the specified diseases. Okay, we'll be seeing now what are the specified diseases. For specified diseases, even if it is a private hospital, some other hospital, it is not taxable. But if it is for other diseases, then only it is taxable. Okay.
Yes, sir.
And if it is provided outside India, then we have to classify the expenditure into three types. One is travel expenditure. Second part is stay expenditure. Third one is medical expenditure. If it is travel expenditure, it is exempted only if the gross total income is less than rupees 2 lakh. But stay expenditure and medical expenditures are exempted up to the limit permitted by Reserve Bank of India. Okay, exempted up to RBI limit, because for this travel expenditure, medical expenditure, for treatment in foreign exchange. So on the basis of information provided by the patient, the RBI must have allowed certain foreign exchanges to be withdrawn. So whatever money, whatever limit fixed by RBI, up to that amount, it will be exempt. Beyond that, it will be taxable. Understood?
Yes, sir.
So now, one by one, we'll be seeing, we'll try to elaborate this concept. First, try to understand what are the specified diseases. Just have a look. If one thing is that specified diseases are relevant for us because, if the treatment is made even in a private hospital for these diseases, it will not be taxable. Number one. And if employee is given a loan for treatment of these diseases, that interest is also not taxable. Is it not? Just have a look at this rule, rule 3A. Like cancer, TB, AIDS, some of the things you can find it out. So these are the only diseases which are for which treatment can be given in a private hospital and it is not taxable. Okay. Should I move?
Yes, sir.
Just have a look and have a understanding. Otherwise, at any point of time, you can refer to rules 3A of Income Tax Rule 1962. You know how to go to the income tax website and refer to this rule. Yes or no?
Yes, sir.
You can find it out.
Yes, sir.
Okay, you can find it out. Now, this part, let me explain you. This particular side will be relevant to answer your question. Now you see. Now, value of medical facility, how to arrive at. Now you see, the following shall not be perquisites. That means what? These are not taxable. What are these things? Medical treatment of an employee or his family provided in a hospital owned or maintained by an employer. Let us say employer is owning a hospital or employer is maintaining a hospital and this facility is provided in the same hospital. So that is not a perquisite at all. So when it's not a perquisite, it's not taxable. Okay. So your ESI hospital is not coming under this category in your question. Now, but second thing is that sum paid by employer for expenditure actually incurred by employee in a hospital. Employee is incurring some expenditure and employer is making payment. Okay. In a hospital which is maintained by employer, either it is maintained by the employer or by government or local authority or a hospital which is approved by central government. So now tell me, ESI hospitals are maintained by whom?
Yes, sir. Corporation.
Okay. That means it is maintained by government.
Yes, sir.
Or by a local authority. Okay. And in not only ESI hospital, there are many hospitals which may not be maintained, but they're approved by central government for some specific diseases. But in that hospital also, if it is made, then that is not a perquisite. Or it may be a hospital which is approved by Chief Commissioner of Income Tax. Then also it is not a perquisite. Okay. So consequently, so we have to see that who is maintaining the hospital and who is owning that hospital on that basis. So it will be a tax-free perquisite or it's not a perquisite. And here the treatment may be given to the employee or his employee's family, and here family includes spouse, children of the assessee, whether dependent or independent, parents, brothers, sisters, individual brothers and sisters of the individual wholly or mainly dependent on the assessors. So spouse, children may be dependent, may be independent, but parents, brothers, sisters can be included in the family if they're wholly or mainly dependent on the assessor. Okay, so that is a debatable thing. One can argue that whether they're wholly dependent or mainly dependent. Okay, and here you see there has been many case laws are also there. Many disputes are there here, whether hospital is maintained by the employer or maintained by government or not. So many times this question comes. So people argue that it may be a tax planning also for the employer. You see, it says that if the hospital is owned or maintained by the employer, the perquisites will be tax free. Is it not?
Yes, sir.
But nowhere law has said that hospital is wholly owned or wholly maintained, or fully owned or fully maintained. So there is a possible, on the basis of some case laws, I'm telling you, there is a possible that an employer might be maintaining something or might have donated something. Employer has donated, let us say, 1,000 rupees for maintenance of the hospital, and can claim this is the hospital maintained by me. Yes or no? As a lawyer, what will be your argument?
So that has to be a considerable sum of amount, like
No,
1,000
that is not.
so
You see, you cannot write law. No, the law has said it is maintained by the hospital. It is maintained by the employer. So employer has donated 1,000 rupees only, or 100 rupees towards maintenance. Now, question is that hospital maintained by the employer? Answer might be yes. He has contributed for employment. Consequently, it will be tax free. So try to understand legally how this particular situation can be used as a tax planning device also.
Sir, if we see it that way, then this can be a very big loophole, and people might use
Yeah,
it to
laws,
do.
there will be loopholes. There will be loopholes.
People
But
might use it for their
benefit of
advantage.
loopholes should go to the assessee in that kind of situation, because it seems the intention of the law is not sure, that nowhere law has said that hospital is fully maintained.
Yes, sir.
Okay, the word fully is not there, so you can understand the intention is not that, even a
So
partial.
people can easily evade from tax by doing this.
Yes, those who can apply mind, they can do it. That is tax avoidance, tax evasion. That's why I'm saying no. The law, as a
And
law,
this is
student, you
legal.
know, you are reading this law, but you can also think at the same time what are the possibilities.
Yes, sir.
Okay, so
Yes,
if
sir.
you are the employer, if you want to make it tax free, then you can simply do this thing. Annually donate 1,000 rupees for this year's maintenance. I'm sending 1,000 rupees. Let the hospital maintain the entire thing with 1,000 rupees. Then you can say this is the hospital maintained by me.
Yes, sir.
Okay, so this is an extreme example of tax planning possible. Okay, very well, it is possible. We
yes,
can
sir.
think in that line. Now, I think I have addressed your question that medical facilities is provided. So what is important is that you have to see who is owning, who is maintaining the hospital. Is it approved by Chief Commission? And is it for some this specific diseases or not? These are the things which are relevant for us. But premium paid by employer to General Insurance Corporation for health insurance or medical insurance premium, they are not perquisites. Okay. And it is also pertinent to mention here that when amount is payable for treatment outside India, the medical expenditure to the extent permitted by RBI is not a beyond that, it is a perquisite. If the gross total income before traveling expenditure of an employee does not exceed 2 lakh rupees, travel abroad for patient and one attendant is fully deductible. That means fully not taxable. Stay abroad for patient and one attendant to the extent permitted by RBI is deductible. Okay. So this is how, if treatment is made outside of India, that perquisite will be there. So next perquisite is car perquisite. But before coming to car perquisite, so I'll will do one thing. I'll expect that we'll once again learn this medical facility provision and do one small exercise on that, so that it will be clear to you. So we'll stop here today. In next session, we'll start from this point, medical facility. Then we'll go to the next part.
Okay, sir.
Okay, friends.
Yes, sir.
Okay, sir.
Thank you very much.
Thank you, sir.
Thank you, sir.
Thank you, sir.